Gentlemen, welcome to the live webinar. This is Sri of Phil Futures, and we're here today to discuss the FOMC meeting and how it's going to impact your trading in the next couple of months. All right, so with here today we have Trading Central Senior Technical Analyst Gary Christie, who's going to walk us through the FOMC meeting and the potential trading opportunities for investors in gold and currency futures. All right, Gary Christie is the Senior Technical Analyst for Trading Central on the U.S. Equity and Commodity Research Desk. The outline for today, the key points that we're going to be touching on is will the U.S. raise interest rates once again, and the kind of strategies that you should be utilizing to take advantage of the potential opportunities in gold and currency futures. At the end of the seminar, we would be having opportunities for you to do a Q&A, and if you have any queries, feel free to type them in the question box at any point in time. This is Sri of Phil Futures, and without further ado, I'm going to hand the reins over to Mr. Gary himself. Gary, are you all set?
Hey, can you hear me?
Yes, I hear you loud and clear. Can I just do a quick check? Can everyone hear us very clearly? If you can, please do type yes in the question box. Oh, the chat box, if you prefer.
Yeah, please do if you can hear me okay. I have been having some little difficulties with my presentation GoToMeeting, so in case something happens, of course I'll log right back in, just hang on the line. But it looks like we're good now. And if you can
looks like everyone can hear you, Gary.
Perfect.
Over to you now.
All right, well, thank you everyone. Thanks for joining me today. Again, my name is Gary Christie. I am the head of North American Research for Trading Central. I am here in Ottawa at 7 a.m. for you guys. I know it's the evening time for you. Maybe you're having some dinner and hopefully relaxing after a long day. For me, my day is just starting, and it's a nice, brisk, cold 10 degrees here in Ottawa. But today, we're going to talk about FOMC meeting, the upcoming dates, and more so a technical outlook of what to expect in some key investment products as we go on to the next two meetings. So on the homepage, you can see there is a really awesome CME Fed Watch tool that we use here on our desk every day. I encourage you to check it out. The link is in red here on the screen, or you can just Google CME Fed Watch tool. It'll come right up, and you can track the countdown and the prediction and the probability of the Fed raising rates. So it's quite a cool tool. I encourage you to just open it up and maybe have a look at it while we're following on the presentation, and we'll have a link again at the end of the slides as well. And of course, just ask us in the chat box if you missed it. But moving along, just keep in mind here that basically it's not any kind of sales pitch at all by me here today. We're just here to give you some education on how to trade the Fed. So we're not here to give you straight advice. I'm just here to give you some outlooks that Trading Central is providing to its clients on some key products and what to expect from the Fed. All right, so just before we begin, I'm just going to give you a little bit about some information about Trading Central. So we are a leading investment research provider to financial market professionals. Our technical strategies cover equity, index, forex, commodities, and fixed income markets. Our market depth and knowledge is attributed to our acquired experience on many trading floors of many banking institutions all over the world. So technical analysis is in fact our core business at Trading Central. Our award-winning methodology is backed by time-tested indicators. Our chartist and mathematical approaches match requirements of various investment styles, from intraday to swing trading and long-term investing as well. So a lot of leading financial institutions rely on our expertise, but over 150 global institutions follow Trading Central in 45 countries for our analysis. So that is a little bit about us and what we do in our core business. And then let's move on to myself and who am I? So I am the head of, again, Trading Central's North American Research Desk. Our analyst team provides technical analysis and trade recommendations on almost all asset classes to institutions all over the world. Before joining Trading Central, I was a trader for TD Bank, where I was an equity options specialist. I've been an active trader for over 10 years, and I've been helping fellow traders build disciplined trading plans to help them become consistently profitable traders. Now, that's enough about me. Let's just get into some of the fun facts of what's going on in the FOMC. So what you can see here, I've attached a chart from investing.com, and this is what the Fed has done. Quite a nice visual, and basically here, all rate decisions were spot on with forecasts indicating good communication by the Fed that helped forecasters predict accurately the last 2 years of interest rate changes. So will the next rate announcement on November 1st be in line with expectations? We can see the forecasts are for rates to remain the same in November at 1.25, and then a possible rate increase in December to 1.5%. Quite interesting. So this is the trend. We've been quite flat until January of 2016, and slowly we're creeping up here. But we've been pretty much spot on. It's been no major surprises here from the Fed. So first off, just understanding Fed rate hikes. So the 30-day Fed funds rate is the most heavily influenced by the Fed's rate hike decisions. Right? So these contracts are priced at 100 minus the average daily Fed funds rate. So when the Fed hikes interest rates, you can bet that the 30-day Fed fund rate will rise as well. So if you want to predict when the Fed rate will actually hike rates, just look at the 30-day Fed fund futures rates. We'll go into how we can look at that and interpret it. So the 10-year T-note is also sought after as a safe haven for securities. So prices will rise during times of economic or geopolitical uncertainty, especially when the risks are overseas. The T-bond futures also behave in a similar fashion to that of the T-note futures, but here the influence of the Fed rate hikes is even more limited. So the 30-year T-bond markets are open to the forces of the traders and their perception on the U.S. government's ability to repay the principal. So the T-bond futures also behave similar to the Fed rate hikes, but not as much as the 30-day. So here I just grabbed a screenshot from the CME website on the actual 30-day Fed fund interest rate futures, and what we can see here after the September 20th rate decision, we had a continuation, a huge bar to the downside, and a continuation lower to 98.63 to 98.7 right now average. This was a couple days ago, but just to show what the Fed is doing, a great way to check out, look at this Fed fund rate chart, 30-day, on the CME website or any platform you're using. Of course, this one here is what we use. We don't actually do a technical analysis of the 30-day Fed fund rate at Trading Central. A little too short-term for us, but here's how you can interpret it. So using the 30-day Fed funds December futures contract, we can calculate what the market is pricing in for a rate hike in December. So this, again, something I just grabbed right from the CME website on charts and price action for the 30-day federal funds futures. So in red, I have drawn here and outlined the current price of that contract, 98.72. So how can we use this? So just a quick formula that I use, you just take 100 minus 98.72 and you get the spread, which is currently, at the time of doing this, this was yesterday, it was 1.28, which is quite interesting. So we can see 98.72 on the chart, 98.72 last price on the CME website, and we're pricing in 1.28 for December, which maybe we do not raise rates in December, but just it's important to watch this spread as we get closer to December to see if it reflects the 1.50%. It's pretty widely common out there that the probability of them raising rates in December is quite high. The Fed was talking about one more rate increase this year, but we got to prepare for the unexpected. Maybe some traders are not pricing it in quite yet for the December rate hike. This is an interesting quick formula to see what the Fed is doing using the 30-day federal funds futures rate. All right, so just to reflect how that looks on the Treasury note on these announcements, and it's important to know the volatility in these key announcement dates. So I have the Treasury note futures contract 10-year in front of us right now. What we can see, March 15th, the rate hike to 1% confirmed a double bottom on the chart on the 10-year note futures. Quite interesting here. Big move we had from the 122 downside. So and then all of a sudden, on June 15th, rate hike to 1.25, formed a large engulfing pattern on June 15th, and then we actually retraced back down. Right, so July 26th here in red, the rate decision was no change, and in fact the contract declined that day, and then we continued to move higher. So overall, when you're using technical analysis, it's more important to see the overall pattern or trend of the product you're trading instead of trading the news directly, because you can see some mixed signals here of how the market reacted to these rate decisions. What's more important here is the September 20th, which was a key movement in the on all the contracts of Treasuries. Even though they kept the rates the same, the 10-year broke below this bullish channel formation, and we've been under pressure since. Quite interesting. That is a key technical event here on the breakdown, September 20th, and you'll see a lot of products and commodities reacted to this September 20th date. So it's important to know how the Fed can actually affect multiple products. That's why we're here today, to look at some price action during these key economic events. So I'm just going to show up the U.S. Treasury bond, a little longer term, but I'll flash back and forth. You can see volatility just tightens up a bit. Not a big reaction here, so we don't expect much to change on longer term bonds. Mainly the 30-day we're looking at that has the volatility to show the Fed announcement. But here, really not much change in the contract, but still a breakdown and a bearish sentiment on both Treasuries. So all Treasuries are looking quite bearish right now long term, which makes sense as yields are going higher. Okay, moving along, just checking, make sure there's nothing on our question box area. So if you have any questions, feel free to put them in the box. I will try to answer them as I go on, so I don't forget any for you guys. But moving along, so one thing I like to do as a technical analyst is do ratio analysis. That's just a personal preference of mine. I like to compare all products against each other to see, what is outperforming, and I want to be in the best performing investments myself when I'm trading. So the fact that the U.S. interest rates are rising faster than elsewhere on the globe is boosting the dollar, the U.S. dollar. So a rising U.S. dollar usually hurts the price of gold, and in fact it is right now. So this chart is a quite interesting chart here where we're showing the dollar index near the start of September, the circle on the chart, right, turning up basically when Treasury yields turned up. So this is coinciding with the decline in gold. So it also makes economic sense that a stronger global economy would favor metals like aluminum, copper, and steel over gold. And this is certainly the case here. We have a nice ratio chart here of this is the dollar index compared to gold spot, just to give you an idea of what is outperforming. Clearly the US dollar here is rallying against gold since September. Quite interesting right now. So we have a trend line being formed right now, and now it's a question of, do we continue higher or test that rising trend line? But for now, US dollar looks quite strong, but this is very short term. So we normally analyze daily charts at Trading Central. This is short term just to see something is happening, something is changing in sentiment right now since September in the price of gold. Where do we go from here? Looking at gold, well, let's look at looking at gold and the US dollar. We'll compare both. So let's have a look right now at the US dollar index just to give you an idea of what this looks like long term. Here we go. This is Trading Central's view on the US dollar. Right now we do remain bearish at below 94.35. And this is interesting, as below here you can see the US dollar strength versus the S&P 500. That's my baby, my main index that I cover here in the North American desk, and we can see it's clearly underperforming. But for how long? Some interesting setups happening here in the US dollar where we've broken above the 20-day and 50-day moving averages. This is a bullish cross here with the moving average crossover. We also can see a possible head and shoulders bottom pattern forming. This is very interesting. So we don't want to confirm a bullish bias in the US dollar until we break 94.35. We're all about confirmation first here. We don't want to pick bottoms or tops. We're looking for trends and confirmation that the trend has reversed. So overall, the US dollar has been under pressure for quite some time since the beginning of the year. But just to be cautious here, a break above 94.35 would be significant for a move higher in the US dollar and maybe some relative performance against the S&P 500. All right, so moving along, This is another interesting ratio analysis that I like to do. So the US dollar has been declining since March relative to the 5-year T-note. This is the 5-year futures Treasury note. So as yields started to increase in September, like we talked about before, the ratio of US dollar to Treasuries formed a bottom and broke above a declining trend channel. So now the US dollar is outperforming Treasuries. Very clear to see here when you sometimes when you do a ratio analysis of two products, you get a better picture of what's happening. So we see US dollar declining in a nice bearish trend channel, a nice bottom forming at 0.768 on the ratio, and we have now huge momentum to the upside of the US dollar versus Treasuries, which ultimately makes perfect sense. Treasuries should decline, yields are going up, good for the US dollar. All right, now comparing that before as we were from US dollar to gold, let's just throw in a gold futures contract, continuous use gold futures right now. Not a very clear story here. So it is quite volatile, and we have key support here at 1272. And we got to remain above that to have any hope for gold to go higher towards our ultimate target of the September highs at 1362. But as yields started increasing in September, we see pressure to the downside in gold, and we've tested this bottom here at least once, 1272, and we're trying to test it again. We could break down below this any moment now, but this is the story so far in gold, where no clear picture. I mean, personally, I don't like to trade any investments that don't have any major long-term trend in play yet, so we're waiting for confirmation. For me, if the gold broke above that 50-day moving average at 1300, maybe we have a better story for a long here, but for now, it's good to remain cautious. Most likely choppy to a consolidation happening right now in the product. Moving along, we have silver, just to show quite tightly correlated to gold. Let's go back and forth. You can see gold and silver, very similar charts here. A little tighter range, but 16.35 is the major stop here in silver. But we expect a consolidation until at least we break above the most recent highs around 1730. But for now, it's choppy, no real picture long term in silver, no real effect except for the fact that yields went up in September. Same with gold, silver declined in the short term. All right, we'll move along. So one interesting name coming up recently, and a lot of requests we get on our desk here, is in fact copper. So here's a copper chart right now, and we can see a nice rounding bottom forming at 2.93, and we've now just made new highs with huge momentum coming in play here around 319 now. So we expect further upside in the copper futures. 328 is the first target, then 334, and we can see moving averages trending higher here on the 20-day and the 50-day. And I like to compare it to something always, so I'm comparing copper to the S&P 500 to see if there's any kind of correlation here, and it tracks pretty much spot on performing with the market in the US. So it looks quite nice, and copper stocks have been rallying and making some moves higher now. So this is interesting play in copper for sure. I'm just going to pop in to see if I can see any major questions. I think we're good for now, but again, we'll come back to some after for sure. And moving along, here's another ratio analysis I like to do, as I said before. So one thing looking at copper, you can see copper is quite bullish, but how does that compare to other products like gold? And as I was saying before, gold has been less favorable to the US dollar and other metals. And we can clearly see that here. This is quite a shocking ratio chart that we pulled up yesterday, where this is the continuous use, continuous contract for copper versus continuous contract for gold, daily chart. And we can see clearly that copper is outperforming gold. Maybe it's something I want to remain in and consider if I'm trading short term. We have clear outperformance, a nice bullish channel. The question now is, do we get a pullback in copper to the lower end of this rising trend line in the ratio to gold? Does gold start to outperform copper in the next month or so? It is possible if you're playing out this channel, but this is reacting a lot like the S&P, which we'll see here next, where we just continue to make new highs. But very interesting picture on the ratio. Clearly copper outperforming gold right now. All right, moving along to The main product that I cover here on our U.S. desk, the E-mini S&P 500 daily. I get a lot of questions on this one. A lot of people asking, you know, where's the top here? Are we going to reverse? Are we going to continue higher? It's hard to predict, you know, price action when instruments are making new highs from a technical point of view. But we can build a trading plan, as we do here, so we can see E-mini S&P 500 remaining in a bullish uptrend, supported by a rising trend line, and we have a target trend line on the upside. What's interesting here is that we have basically the E-mini S&P remaining above the 20-day moving average since at least September here. And that is the first warning sign. So people ask, you know, Gary, where is the reversal going to happen? When is the warning sign? What should we be cautious about? And the first signal will be a close below that 20-day moving average, and then ultimately the 50, because we can see in the blue line here, the 50-day moving average has not, you know, has been playing most of the time a support role with some choppiness, but overall we're playing that rising trend line. That's what matters here. We see relative strength breaking above a declining trend line that was in place since March, and now here's a warning sign. The only one we can see here is relative strength is breaking down from its momentum since August. But price action is not confirming it yet. This is what's called a possible bearish divergence. When you see an oscillator like the relative strength index breaking down when price action is still at or near record highs, it could be a warning sign or it could be nothing at all. If you broke below the 70 zone from this overbought area, maybe it's a more confirming signal. But for now, you know, trend is our friend intact here, and we expect the 2640 ultimately to be reached on the S&P 500 unless we see any sort of breakdown. And even a breakdown wouldn't be as, you know, extreme or bearish long term. It would be expected to test this rising trend line at some point. So we would just be prepared for it. But for now, no real signals here to worry about. This market continue to go on higher here for quite some time. You don't want to get caught trying to pick a top and just get washed out, because the market's been resilient. So it's been amazing, to be honest. I've never seen this in history, how fast this has gone up and the momentum behind it. So for now, we're keeping to the long side until we get at least 3 technical reasons to get short or to at least close our long positions. So for now, it looks great. Now, how does that look compared to Treasury Notes with the upcoming FOMC meetings? Again, here's another ratio chart we will show you. Here we got relative strength SPX, S&P 500, versus the 5-year T-note. This is the futures contract, continuous contract. Or this is the most recent one, the Z7 contract. So we can see picture is quite clear here. More stocks are outperforming the bonds. So we have the SPX clearly outperforming the 5-year, which is, I'm using a 5-year as a more shorter term note, shorter term treasury, just to track the volatility when it comes to the FOMC meeting and the rate decisions. Gives you a clear picture here. This ratio is now at all-time high, with the SPX is pushing higher versus bonds, which is to be expected right now. But again, a pullback in the market still wouldn't, you know, change our view long term on equity markets in the S&P, as we're supported by a rising trend line on the ratio. So it makes sense to have a pullback. But for now, definitely equities are outperforming here from this chart. And Nasdaq, interesting chart pattern here. So Nasdaq futures we're showing here, daily chart. We've been supported by a rising trend line since December of 2016. What's happening now is that we're forming kind of a rising wedge pattern, which could mean 2 things. This could break out higher and be a continuation, and it'd be a strong technical signal if you broke above the 6230 level. This would continue on, or we have a massive breakdown if you break below that rising trend line towards 5570. So not a clear picture as the S&P right now. Nasdaq has been under a bit of pressure. I see Nasdaq futures right now down about 10 points before the open today. Some tech names are getting hit. Google's been getting hit, so some stocks are affecting that index. But for now, the ultimate bias is bullish alongside looking for 6385, and we use these targets. We use Fibonacci extensions to predict our targets. They don't always work out perfectly or accurate, but that's the best we've got, using Fibonacci extensions for our target prices. But for now, we see relative strength that did break above a declining trend line. We bounced off it, and now we're continuing higher. Hopefully we get a rebound here. So we're waiting for a rebound in the Nasdaq. Not as clear picture, not as pretty as the S&P 500. Let's see if there's any questions here. So yeah, someone just quickly asked, why do we choose an RSI with a 9 MA? So we usually use a 14-period RSI with a 9-period moving average. That is our own preference, just to catch the swings from our methodology. And you have to keep in mind that Trading Central, we've developed our own tested methodology of over 18 years we've been using it, and this is what works the best for us, so we don't get too many whipsaws, but we catch the moves quickly. But this is just our preference. A lot of traders customize their indicators. This is just what we use that works the best for us, and this is our standard format. We only use one indicator on our chart analysis, the RSI. But there's many out there. I mean, we still, as an analyst, we still consider other ones like the MACD, and I like to use stochastics. But for us, we like to keep it simple when explaining a position and a chart with this methodology here. And I'll move on because there's lots to cover, but I'll try to grab your questions as we go on. Thanks for the questions. Will the rising dollar have any effect on the crude oil? We'll look at that soon, actually. So just hang on. We'll get there to crude. Just before we go, let's finish off the U.S. indices. We have the Dow Jones, which has been unbelievable. We see further upside and huge momentum behind the Dow Jones. It's clearly outperforming all indices. And you look at this chart here, we have not broken below the 50-day moving average probably since May. So we're watching as a warning sign, the 20-day moving average, that would be a warning if you broke below it, and then ultimately the 50-day. But this top here, we bounced at 22,400 is our stop loss on the Dow Jones daily chart, of course, and we're looking for 24,200 as an upside target. But huge momentum here. It is not unreasonable to expect a pullback, but we just don't want to, predict it now until there's a warning sign. As we can see here from relative strength, this break of this declining trend line has been quite positive. We see good, strong momentum in the RSI, so it is clearly a leading index right now. Keep in mind the Dow is price weighted. It's going to be skewed a bit compared to the SPX, but here, definitely with the earnings in play, the earnings season, this Dow has just been soaring. And just to look at that in a better picture, this is quite phenomenal. So I was sitting there with our analysts yesterday looking at relative strength against all other indices. I put up the Dow index versus the S&P 500. Quite amazing, when normally they're usually tightly correlated between Dow, Nasdaq, and S&P. That's how we treat them here at Trading Central, but there's no denying it here. From the period of 2017, the beginning of this year, January, just until September, or even July, August, September area, normally we're well correlated. We're in this nice consolidation in the ratio of the Dow versus the SPX. Then all of a sudden we just skyrocketed above this consolidation zone, pulled back, tested the recent top of the ratio as support, and now we're just soaring higher, straight up, which is unbelievable. So definitely we can clearly hear that there's no argument here to say that we're not Dow is not outperforming the SPX. It's quite amazing to see. And here is crude. So in terms of crude, I don't really compare it to the US dollar here. I'm comparing it more to the S&P 500 to see what is happening. So crude hasn't been a great picture here, but there's some interesting setups in play. This is a daily chart of the crude oil continuous contract, right? We can see price action broke above a long-term declining trend line, and this was major resistance for quite some time, since February. We broke above it. We broke above all moving averages. It, more importantly, broke above that 200-day moving average in green. And we got the 50-day now turning up above the 200. That is a big bullish cross, golden cross, in technical analysis terms, where we're looking for further upside to 54. Now, basically, our stop remains at 49, and that's a key support level where we touched back in the beginning of the month. And we're looking to break out of this consolidation zone, break above the recent highs of 52.85. But again, I always like to compare a product to something else to give me a better picture. And we can see, is it possible that we have crude oil outperforming the S&P 500? Likely it could happen. So what we're seeing here is below this chart, crude oil versus SPX, and the green line is a 200-day moving average. and we are just touching it now, and we have rising trend line support. So we could see a break of crude if we get a break above the $53 range, where we see crude start to outperform the market, and that's quite interesting. A lot of people have been waiting for this move in crude, but we have to be very patient right now until we get a confirmation of this trend. We could even see a possible bullish trend channel in place here forming, but not quite confirmed yet. We need to see a break above the highs. I would love to see it above 54 and ultimately 55 to see a nice roaring bull market in crude. But that's the story so far. And let's just get into some currencies. I know I'm running, past half hour past, so I want to leave some time for questions. So I'll get through a bunch of charts here for you, and because they're all quite interesting, and I could talk about charts all day with you guys. So let's just get to the main ones. Euro-US dollar pair. Very interesting setup here, where we've seen strong support since April, with the 50-day moving average acting as support in blue. And now what's interesting is in September, again, same moment as we started rising yields in the Treasuries, we had a breakdown below that 50-day, and it's acting as resistance right now. Again, this looks a lot like basically what we're seeing in other products, where you have this head and shoulders pattern, but this is a head and shoulders top possibly forming, but again, no confirmation yet. This is reacting inversely to the US dollar index that may be posting the exact same thing in reverse, which is quite interesting. But from here, we got to maintain our bullish bias above 1.161 area on the euro-US dollar, just because we have no confirmation yet of any downside break. So the most important thing we can do when markets are acting the way they have been these days as a technical analyst is to wait for confirmation and don't try to catch the tops or bottoms. Here, we could have a continuation higher above to 1.22 ultimate target and break that high of 1.209. But for now, it's just chopping around between the lower Bollinger Band and the 50-day moving average. So if you do get a breakdown below 1.16, that would be significant and would correspond to the strength in the US dollar that we've been having here. So although US dollar has been short-term, seeing some strength and momentum, daily charts, Trading Central, we were waiting for confirmation, and then we'll catch the trend. We're not trying to catch tops or bottoms here. I can't stress that enough, that we got to wait for confirmation. And let me see here. So do we use, I just see a question popping in. Thanks for the questions, guys. Do you use Bollinger Bands as a part of your analysis? How useful is it in a trending market? That's a fantastic question. So thank you for that. Well, basically, we do use Bollinger Bands. And every chart you see here today, we have the red lines on the outer edge of the price action. That is the upper and lower Bollinger Band. And we use it for standard deviation analysis. So we most of the time, over 90% of the time, price actions just stay between these bands. And when we create price targets, we want to keep in mind volatility. We don't want to give our clients price targets that make no sense from a volatility perspective. We have to have a reasonable chance of getting to your targets. That's how you make money, is reaching your targets. And so we use them as a standard deviation tool and volatility tool to make sure, is there a chance that we can get below 1.16? Well, we have a lower Bollinger Band here that's testing just above it. So if you do break below the Bollinger Band, maybe that is a bearish signal, because that would also stop us out on the euro-US dollar here. And we can see the Bollinger Bands contracting. And there's many ways traders will use Bollinger Bands for trading. If you're short term, you may be buying it when it pierces the upper end, like it did in July in the euro-US dollar, and you would have made some good money riding that upper Bollinger Band. Or some people like to use it basically as a tool to see when they're contracting, when volatility is squeezing here like it is right now. Normally, that would indicate to expect some further volatility upcoming in the future with the breakout, with those bands widening. So I like to use it for that reason. When we see a consolidation, we are expecting a breakout to the upside here, but that could happen to the downside as well. That's why we tighten our stop. So we're using Bollinger Bands to build a trading plan and tighten our stop loss here, because a significant break below would confirm two things: a break of the lower Bollinger Band and a break of a major support level and stop loss, and would confirm a head and shoulders top. So that's kind of how we use it. They're quite useful for us. In the trading market, we use it just to basically build your plan to make sure your targets and stop losses are accurate. For me, I would say if you're using Bollinger Bands in an uptrend, I would use a lower end as a stop loss. Just to give you a rough idea. But great question. Moving along, we have the US dollar yen. So we see here, this is one of the most interesting pairs that I included in this presentation because we're getting a significant technical event where overall, since January 2017, it's been choppy sideways price action between 107 and the 116, 115 area. But now we can see a breakout to the upside from this declining trend line just happening now, and good lead into the Bollinger Band question that we had. We see a price action above the upper Bollinger Band. This is showing signs of strong momentum, and as they contracted and they squeezed here when they were consolidating, you can see now that they're deviating away from price, both Bollinger Bands. So this is an indication of future volatility, price expansion to the upside. It's a momentum, basically a momentum signal here. And we see the relative strength RSI above the 50 level moving higher. We almost have a new high since basically August. So keep an eye out on the US dollar yen. We can see a new uptrend in play here towards 118 to test the highs of basically the end of last year. Quite interesting setup. And Aussie US dollar, I did include. Aussie US dollar does trade a lot like the CAD, Canadian dollar we use here, so I'm including this one because it's quite interesting when we had a breakdown, which corresponds to a review with the strong US dollar. So what we can see here, a nice declining trend line break after the Aussie dollar topped at 0.8125, and we want to see this major overlap support level. 0.771 is here as a target because it was in fact resistance back in February up until April. We broke above it in July, and now we're testing it as support, and we're looking for a further breakdown to put in the 0.7565. As you can see, relative strength in the RSI is weakening, capped by a declining trend line. So we want to be bearish this product, and of course US dollar has been showing some strength, so it makes some sense here. But again, no clear trend, so this would be a high risk trade if you're looking to trade the Aussie dollar. We like to trade currencies that have some kind of identifiable trend long term, and then you can trade them, of course, short term on the right side of the overall long-term trend. You want all odds in your favor when you're trading, of course. So although you may not trade off daily charts, of course, because FX trading has leverage and is very volatile, but it's extremely important to understand the long-term trend to have all odds in your favor when you're trading. And this is what we're trying to do here today, is to give you a picture of the overall long-term trend. So when you're trading short-term, you can have better odds of probability. Now let's look at the cable. This is the pound versus the US dollar. You can see the pound's actually been quite strong. So and the reason for that, we see a nice supporting rising trend line in the pound versus the US dollar. We have a stop loss of 1.29, and we are looking for ultimate targets to reach that high we had in September of 1.366. So also interesting to note, we have a rising trend line, and we have relative strength near the overall average lows of the year, and making a new high now off the bottom. So we would expect to see further upside in the pound US dollar. But it's been, again, quite choppy. So we're getting to an area now where there's a good risk reward for a long, but I would like to see it closer to that rising trend line like we did here at 1.278. That bounced off quite nicely, and that was a huge move in this period. Same effect here back in June. We touched it, and that was forming the rising trend line. And now we have 3 touches of this trend line, so we know it's in play. I like to see 3 confirmations of a touch on any trend line to confirm it's in play. And clearly it is here. I'll be waiting for a pullback to get long here around 130 area. But interesting to see that even though US dollar is showing some strength, cable US pound is showing further strength right now. And moving along, Euro yen. So we have Euro yen. I'm showing this one. This is the last chart I'm going to really show you guys here because this is probably the last most interesting currency pair. What we're seeing here is a nice trend in play. This is what a nice trend looks like. We see a rising supporting trend line, multiple touches, almost 4 here in the Euro yen, and we're seeing a break probably to the upside of above 1.347. And we can see that continuing for the next few months. And looks great here. We can almost draw a bullish trend channel. So that's it for the charts, everyone. Again, I will get to the questions for you guys and I was going to summarize what we learned here today quickly. I know it's been a bit long, but there's so much to talk about. So first off, again, take some notes if you like, or we'll give you this presentation at the end. We can provide you the slides. But what do we touch up on here? Next Fed rate hike predicted on December 13th. The next one in November, probably no change, but you never really know.
Right.
But there is a predicted change to 1.5.
Oh, no. I was using
30-day Fed funds.
The internet or bonds are switcher.
We have interest rate futures are a good indicator of when the Fed will raise rates. The rising U.S. dollar is hurting the price of gold. U.S. dollar is now outperforming Treasuries since September due to higher yields in Treasuries. We see gold is testing key support at 1272. Copper is, in fact, outperforming gold. The Dow is outperforming all U.S. indices, as we saw from that beautiful ratio chart. Very interesting. We also see crude oil may begin to outperform the S&P 500 in the short term as long as it remains above the $49 area. The euro US dollar remains bullish until it breaks below 1.1615, and the US dollar yen is breaking to the upside with quite a beautiful trend line breakout, which was quite nice to see on the chart. And we see the euro yen is a confirmed uptrend. So that's the summary of basically what I talked about today. It's a lot of information there for everyone, so I thank you for your patience in tuning in. We can talk about this forever, but we'll look forward to some future webinars. But for now, this is how to set up your trading. We're coming out into the future FOMC rate decisions. And here again, I'll have a link here to the CME site where you can count down to the rate meeting, and you can see probabilities and some discussions about the Fed upcoming rate hikes. But that's it from me here, guys. It's a pleasure to be here on behalf of Phillip Futures and CME Group, a nice partnership there. I'm here now to answer some questions, and I will look at the floor now. Okay. I got a question here for my personal trading. How many % would you say technical and fundamental? Great question. I keep it simple. I would say I am pretty much 100% technical. As a technical analyst, I believe all fundamental price data or fundamental news is actually reflected in the price already. I follow price action. That is all I do. I look for technical setups reflecting, believing that all that information is already reflected in the price. The only way I use fundamental is to make sure I am not trading around major news events unless I'm prepared to do so and I have a view already. Sometimes a technical setup looks so good, even though you have an upcoming event or event meeting or economic outlook or any kind of indicator coming out, it still makes sense to do so from a risk perspective. We'll still trade it. It's important to always know what is coming out that can affect the product you're trading in terms of news and fundamental analysis. But I don't use it as a trading tool personally. That's not what we do at Trading Central. We're just purely giving price data and our trading plans. Most of our clients have a fundamental view already, and they use Trading Central to build their trading plan and know when to get in and get out. That's basically fundamentally what we do here. But great question. I'm not saying fundamental analysis is better than technical analysis or vice versa. I mean, if you can combine the two, it's always to your advantage. But mainly we use it for risk analysis to make sure we're not trading near major key events or to be prepared for the sentiment that's upcoming when you're trading a particular product. But overall, great question. What's the greatest effect to oil prices? Is it technical or fundamental? Great question there as well. Well, basically, I would say more so right now, technical for me, but I'm kind of biased. So that's my passion, technical analysis. I'd love to chart absolutely everything in the world and see how the world's reacting to everything against each other. But of course, fundamental news is driving a lot of the crude oil price action, of course, based on how many oil rigs are online. Look at the rig counts, like what's happening in the Middle East, inventories. So inventories make a huge difference in price action on the product. But I like to say, there's a lot of smarter people out there that follow that information and can predict rig counts and inventory levels. I'm not that smart to cover that. What I can do is predict the price action on how people interpret the news and all the inventory numbers. That, for me, has been my trading edge for over 15 years. It works for me. So I don't have the time of the day to follow all those reports. I have it, I just look at the price action and draw my trading plan based on where price has been and where do I expect it to go from here. But of course, very fundamentally driven these days. A lot of movements are happening just on tweets these days and news streaming all over the all over the television or on social media. So it has an effect on markets, but we still remain disciplined and follow the charts first for us. But great question. Thank you for the nice, wonderful comments on the presentation. Appreciate it. We'd like to see your feedback, and maybe we can learn more of how to provide you better webinars in the future. And one question here coming in, trading time frames. I should have touched up on that a little bit more, I guess. We use daily for long term. In fact, we use weekly charts, daily charts, and then 30-minute charts at Trading Central for our full outlook. We do zoom in to 4-hour and lower. We do provide 30-minute intraday analysis as well. I'm just showing daily today to give you the bigger picture of what to expect in these volatile products. Because if I do 30-minute charts for you and the presentation is prepared, they'll probably be broken by now. So it's a little harder to do that for you. But I am more a short-term trader myself. Trade normally off 1 hour in FX is popular to 30 minutes short term, but we always use the daily chart for my long-term view. Favorite indicator, great question. So favorite technical most effective indicator, it's pretty pretty hard to pick just one. I like to use a couple. Relative strength has been an easy one for us to identify where price action is moving if a trend's still in play. Personally, one of my favorites is fast stochastic indicator. I'll use stochastics to basically see if a trend's still in play or if we're near a bottom and price action should break out. But lots of information out there to learn on technical analysis. Personally, the way I trade, there's only 3 I use. You can read up on them on Google, of course, as well, or we can have a whole other webinar just on technical analysis itself. But stochastics, MACD, the moving average convergence divergence, is a popular one that gives great trading signals, and the relative strength, to keep it simple. And I use sentiment indicators like advanced decline line. I use a lot. Money flow. I like to see where money's flowing into a stock or not, or any investment. So there's other sentiment indicators you can use as well, not just oscillators like the MACD and RSI. But it's your own personal preference. I would just recommend don't use too many because you will get mixed signals. So we keep it simple here. That's what we do at Trading Central. We only show one, but we consider all of them, but we show one to confirm a signal. And see if there's any other more here. Thank you. So a good question here. Would you expect a big crash? Will it happen? Will it be harm for us? That's a great question to ask. Because I get a lot of clients asking in terms of the S&P, where do we go from here, right? Or do we continue higher, or all of a sudden we're going to wake up one day and the market tanked? Like it did in the Nikkei back in the day. So there's no real warning sign yet, really. So I don't think it would be a drastic crash. I mean, I could be wrong, but you would see some warning signs first. Slowly, you would see a rollover in certain asset classes, maybe a move in gold higher. We don't know. But for now, I think it would be gradual, and it is okay to expect possibly even a 5% correction in the market overall would not be unreasonable. I mean, that is something we're due for. We haven't had in some time. So I wouldn't panic if there was a rollover. It's expected. People will be taking profits. Coming to the end of the year, who knows what will happen, right? But I don't expect a major big crash. I think people are prepared for it. At least if you're following technical analysis, you will have some warning signs ahead of time to give you that setup. Look for key moving average breaks. Everything's trending to new highs. So the first thing I'm going to look for, 20-day or 50-day moving average breakdowns. That's your first sign that maybe you should be on the sidelines or cautious, or if you're into a major profit that's outperforming the market, say over 20% gains in certain assets, maybe it's time to ring the register, taking some cash. But for now, no real warning signs there. I don't expect it to just fall overnight, but who knows what can happen. That could be a lot of geopolitical and global news events that could send the market sliding at any moment. You just never really know. It's just good to have a trading plan to be prepared for it. Great question, though. So, am I a swing trader or am I a day trader? How many trades do you personally take a day, a week? So, of course, I don't trade a lot on our desk just because I'm always giving analysis all the time and managing the technical analysis desk in Ottawa for North America. But You know, I've been a trader for long. I've always been a swing trader. I've never been a real day trader. That's just too hard to follow all day. That's a full-time job if you're a day trader. The best chance of success is probably holding, you know, swing trading 5 days, you know, even 2 weeks. That's the ideal range. Is looking for swing trading, getting in a couple times a week and out, a couple times a month, maybe 15 trades a month on average. Depending on how many products you trade at once and how much you hold at one time. But swing trading for us has always been the better chance of probability. When you look at our 30-minute charts on Trading Central, for any equity or futures product, we expect that to play out within 2 to 3 days to hit our targets. It's important to remember that. We're looking for targets to be reached in a reasonable time frame, 2 to 3 days, if you're using 30-minute charts. If you're using daily charts, that could be 2 weeks, upwards of 3 months. But I like to see it play out within 30 days, because it all depends on your trading style, and you have to make sure you're trading a time frame that you can manage. If you're having, based on your personal life, if you're working or not, you don't want to be panicking and want to be able to sleep at night. So make sure you can handle and be prepared to hold a position for 3 to 5 days if you're a swing trader, and not worry about the intraday swings. It's hard to do that. It takes discipline, but it will improve your odds of success for sure if you stick to one certain time frame that works for you. So with SPX, waiting for bearish signals. Which one is it? So you see here, price below the 20 EMA would be a sign of a bearish signal. Price below the 50 would be the second major one. You're right on the SPX, and basically I was looking for relative strength after to break down. If I can see. Do we have an SPX chart? Here we go. Yeah, so on the chart right now we have one warning signal, RSI breaking down, but not really a major concern. Got to see the 20-day breakdown and then the 50-day breakdown. If you close below the 50-day again, I think that would be the sign that this trend is over in the short term for the S&P 500. Good question. How does the Venezuela default affect the market? That's a good question too. Something I don't really track, to be honest. I only track our U.S. markets and how they're reacting. It could be a great effect, or it could be nothing at all. That's the funny thing about of news coming in and how the market disseminates it. We just don't know how it'll be affected in the long run. I mean, is it a big player in terms of the U.S.? I mean, you see the U.S. market and all the fundamental news coming out, and threats of nuclear war out there, and nothing has really pushed this market lower. So I would personally suspect not. It would be no major effect in the market with Venezuela defaults, but I mean, I could be wrong. But so far, it's been hard to prove this market, push this market down on any news. That's the amazing part of what we've seen in the last few months. Nothing is breaking it down yet. Something will come, most likely. Who knows what that will be? But for now, the market's been too resilient and too strong to see Venezuela affect this market right now. And you're absolutely welcome. Any other questions out there, everyone? I know we're pushing into the end. Personal thoughts on Bitcoin. That's a great question. I have this debate with my analyst desk and my team, because we have a lot of guys that are big fans of Bitcoin. I'm not a big fan of Bitcoin personally, just because I don't know who to call if I have a problem with my account, or my money goes somewhere, or my Bitcoins disappear. However, what's interesting about Bitcoin is that it reacts beautifully to technical analysis. It's a lot more emotional, and you see a lot more patterns happen in Bitcoin. So I'm not saying it's bad to trade at all. If you're if you're a trader, I know guys making great money trading it because and purely technical analysis for reasons, because it's just more psychological. It reacts more to events. The patterns are beautiful. When they break out, they confirm each other. It's quite nice to see how technical analysis plays a huge role in trading that market, because what else do you really go on, right? So it's very psychological, and you can predict human behavior quite well using technical analysis and certain patterns that reflect certain mentalities of the traders that are trading that product. So not against Bitcoin. I don't have any experience personally with it, but what I do like and what I've seen is the fact that technical analysis goes hand in hand with it in the trading, and it's been quite nice to see those patterns play out more so than most equity markets these days, or most stocks that I've seen. But great question. I mean, who knows? Maybe it'll take off and that'll be a major product. I would love to see derivatives. I mean, I'm an options trader by heart in the background. From many years at trading the markets, I've been using U.S. equity options. And if there was a derivatives market, maybe I'll be more interested in Bitcoin. But for now, there is none, and I like to sell premium and trade options. It's a whole other discussion, and how technical analysis can be used with option trading, which is quite beautiful. But for us, right now, Bitcoin had an option market, maybe I consider it. As a retail trader, would you say it is, where to go here? I just missed that question. One moment, I'll get to it right now. I think I lost a question. I'm not quite sure. I'm looking for some more. Again, any last ones? We're coming up to an hour. Let me know. Shove them in the box. If not, we can always get back to you. But great questions, everyone.
You see the question, Gary? I could read it up for you if you want.
Please, if you don't mind. I can't see it in my chat box for some reason.
Sure. Just as a retail trader, what would you say is a healthy aim for profits? 5% a month, 1% a week?
Great question. So as a retail trader, and again, I consider myself kind of a retail trader as well. I mean, when I trade on the side of my current job, I'm looking for consistent, reasonable gains. I mean, if you're making, 5% on an investment in a matter of days, that is above average, right? So as a retail trader, if you're looking, it depends on what you're trading. If you're doing 1% a day, that adds up quite a bit, right? So don't be afraid to take profits. You can always get back in, right? So really, I mean, if you're doing 1 to 2% a day, that's phenomenal. Overall, of course, we try to beat the overall benchmark, which is kind of hard to do. If you look at the Nasdaq, up 25% this year. If you're doing that in your portfolio, you're beating most hedge funds out there. Hedge funds have been, mostly flat, some underwater, because it's been so hard to beat the S&P 500 when you have major names like in the U.S. anyway, major FANG stocks like Amazon's, Apple's, Google's, Facebook's, really driving this market higher. And if you weren't in them the whole year, you probably missed out on most of that move. So it's been, now of course the Dow is outperforming, so you got to be in the right instruments. So hard to beat the market, but it depends. Some traders I know have a daily goal. If you're a day trader, they like to cash out at $200 a day US, some 500, right? And then they just stop trading and go for the next day. I don't like having a dollar amount because it puts a strain on you psychologically to make a certain amount each day. For me, I just like to trade the best setups each day, and I look at my P&L at the end of the month later. But I mean, 1 to 2% is good enough if you're an active trader. But great question.
All right, I just have one more for you, Gary.
Sure, please.
I'm going to add in my modification to the question as well. Okay, my question is, in the lead up to, with FOMC in mind, what are the 3 products that we should look at? And I'm adding the question from Gary Lim here. Coming on to 2018, what should we focus on?
Great question. So for sure, I'd be more focused on what happens to the US dollar, because that's going to be a big driver. Whatever Fed rate decision is designed, if you have higher rates, we're going to see finally some strength in the US dollar. So any US dollar currency pair, I would be trading. I'd be focusing on any major US pair, because we should see maybe some trends develop finally in these products. So US dollar pair, S&P 500 could be another great one. I mean, even if you raise rates here, I think the market's pricing it in quite well, and we're pushing higher. I mean, we're in a period now where the market's been so strong, it's unheard of, that everyone's waiting for a pullback we're not getting. There's no reason why this can't continue for another 6 months to a year in reality. So I would be focused on the US dollar price action event versus all major pairs. S&P, I'm not a big trader of Treasuries. Some people are. I just watched the 30-day Fed funds rate, like we mentioned in the presentation, to see how the traders are pricing in the next Fed rate hike. But I think currency pairs seem to be trending more in the US dollar denomination, and of course the US equities. Of course, I'm biased. That's what I trade here as well. But that's pretty much how I can answer that one. I hope that helps.
All right, thank you so much, Gary. Thank you so much for your valuable insights and telling us the key products that we should look at from as we head on to FOMC and beyond. Once again, thank you for your wonderful questions. The audience were really fantastic today. And we will be sending you a copy of the recording with our follow-up email, so do look out for it. If you have any queries, you can type them to the email which I've provided in the chat box, which is futures@phillip.com.sg. And once again, thank you, Gary.
Thank you, sir. We appreciate it.
And thank you for joining us tonight, everyone. All right,
Thank you, everyone.
that's all for now. Till the next webinar. Bye-bye.
Take care.